All right, says we're recording. Hi, everyone. My name is Jesse Randall. I am the founder and CEO of Sweater, and we are the primary hosts of Founder Saga, where we find ourselves today. Chris Onan, one of the founders of Galvanize, is our guest today. And we're going to be diving in on Galvanize's journey and where that ended up after everything that they did to build out that small empire and exit successfully. Part of what we're going to be going through today is examining that, and then we have some time for Q&A. So throughout, if you have any questions for Chris, or you think about anything about your situation that he might be able to add insight on, please throw those questions in the Q&A, and we'll do our best to get to them here at this towards the end of this session. Otherwise, let's jump on in. Chris, welcome. Excited to have you here.
Jesse, thanks for having me on. I appreciate it, man. When Chad asked me, I was like, yeah, that sounds cool. Nothing wrong with founders sharing war stories.
That's right. Yeah, well, we've got a lot of people lined up. I mean, the vision for this, just really quick, is, we want to have these weekly interviews from now through the end of 2021. And so far, so good. We've got a lot of great founders like yourself that are all lined up. So thanks for spending time with us.
More than happy to talk about the 5 years of sheer terror that I went through in building Galvanize.
Well, let's jump right into it. Okay, so first what we want to do is kind of paint a vision of where Galvanize has ended up. Where's Galvanize today? You mentioned earlier, I'll just give a high level what I know. Galvanize was acquired earlier this year for a couple $100 million. It was founded back in the 2012 timeframe.
First quarter of 2012.
Yeah, so it's about a 7-year horizon there, and all kinds of fun, exciting waves along the way to get there. Personally, I was living in Phoenix when they expanded and opened up a really cool location in the warehouse district in Phoenix, and I was a member there for a couple of years. And so I've participated in at least the co-working portion of Galvanize. But why don't we go ahead and tell everyone what Galvanize actually is? I think that you would probably do a much better job of that than I would.
I hope so, Jesse. I hope that I can give the pitch. We used to, our early team members, I would occasionally pull one of them aside and be like, all right, give me the pitch, and we would work on it, because it isn't as simple as a SaaS business that, powers salons, right? It's a little more complex than that. But the vision for what we wanted to accomplish with Galvanize was pretty simple. There just isn't enough tech talent in the world. If you look at a school like University of Colorado at Boulder, I was stunned to learn that they produce something like 42 computer science grads every year. And this is a school of, I think, like 40,000 people. And I'm like, that just makes no sense. Here you're talking about, I'd been in the venture capital world for 15 years before we started Galvanize, and all I'd seen is difficulty finding tech talent. And so when I got together with my two co-founders, they had designs on something that was trending this way, a little more co-working and a real estate. But as we banged on it, we quickly realized is putting education at the core and then surrounding these students who were learning to be software developers and data scientists by real world practitioners that are software developers and data scientists. It was a little bit like cheating, right? I went to Northwestern and studied for 4 years. And then, spring of my senior year, I went to the placement center to, do interviews and things like that. And I'm like, well, wait a second. What if I could just learn in the placement center? And so the way that it would have worked for me is if I could have had Morgan Stanley and JP Morgan and McKinsey and Bain and BCG and LEK in my econ classes and then drinking beer at the fraternity parties with me, I probably would know what the job is, know what you need to do to be successful. Mm-hmm. And I'd have contacts to get interviews, right? And I would have a reasonable expectation of what it would be like. And that just wasn't how it worked. So we basically gave it a try. We didn't know it was going to work. We just said, look, we think that we can create a program where we can take smart people and teach them to be software developers in 6 months in an immersive environment. And I remember people being like, well, what do I get when I graduate, quote unquote? Do I get a diploma? I'm like, we can print one out for you if you want. But, I think the goal would be that, you would find a position in a larger or smaller tech company, and you would, kind of begin as a junior developer. Now, look, you got to manage expectations, right? We didn't tell people that they were going to come out as the CTO of Google. But what we did tell them is, hey, this is an opportunity to access income mobility, tech skills, and you're only at the beginning of your career. And look, we were not sure if it was going to work, but every single student in that first cohort was hired, I think almost before the program was even over. When we knew it was going to work is the first day. I'll never forget it. It was January 24th of 2013. We had 24 students come from literally around the world to go through the software developer training program. And that afternoon we had a happy hour where member companies could meet the students. And it was like, the energy was amazing. And I looked at my co-founders. I'm like, we got to do more of this. This is awesome. You could just tell that we were onto something.
Yeah, that's great. So did they start out as co-working and then you added the education component, or was it the other way around?
I get this question a lot. And in fundraising with growth equity firms, they always try to tease the business and pull it apart and be like, well, why do you have to do co-working? And, they all fit together, right? Community, curriculum, capital. Those are the three things that fit together to build Galvanize. And that's why it worked. The first thing we announced was the software developer training program, because it was one of a kind and we needed time to find applicants and run the interview process. And then we announced and opened the first campus in Denver, which was, it was a big building, 30,000 square feet. We had 100 community members move in the first day. And then I think that was October. We hurried up to have the campus open for Denver Startup Week. The first year that Eric Matisik and Ben Data and Tammy Dorr put that on. Denver Startup Week, for those who don't know, I think it's the largest free entrepreneurial event in the country. And it's, this year notwithstanding, last year I think they had something like 70,000 people attend a week of events. It's awesome. And so Galvanize effectively hosted it the first year Denver Startup Week happened, which created a lot of energy. So I suppose you could say that we were a co-working space for, 75 days before the students showed up. But the vision was always to put students in the midst of the campus. And frankly, we probably wouldn't have done the campus if we were not running the education business. I mean, the education business, it's just much more enduring unit economics, whereas co-working is commodity. I mean, look at WeWork. If you run that business perfectly, which you can't, it's probably a 20% kind of net margin business.
Mm-hmm. Mm-hmm. Yeah, that's awesome. So what'd you say? Community, capital, and what was the other one?
And curriculum. Yeah.
And curriculum. Yeah. That's fantastic. So, I mean, I guess that gives a pretty good view of what Galvanize was, right? So, I mean, the end point here was that this year they were acquired. Do you want to comment on that just real quick? And then I want to go back in time.
Yeah, no. We can do it all. But so we had the first campus and the students showed up and it worked. All the students were hired. Students came out getting great jobs. We had one student where it was a feeding frenzy to hire her. Pivotal ended up winning. There were a bunch of really big late stage startups, not even startups, growth stage companies in Denver that were slashing each other's throat to hire this student. And I want to say her base salary starting was $120K. And they paid off her student. I mean, it was crazy. It was like, and we were like, oh, we got to do more of this. And so we expanded to Boulder, a small campus. And then we made our big swing and we expanded into San Francisco, a 75,000 square foot campus at 2nd and Howard. You had LinkedIn on one corner, Salesforce a couple blocks away. Wow. And people told us we were crazy. And
this was right in San Francisco? That's where that's at?
Yeah. And so in Soma, 2nd and Howard. And, we had a simple thesis. We're like, it seems to me there's demand for tech talent there too. And probably demand for community for entrepreneurs, probably demand for, a place for capital to find deals. We're going to give it a swing. And it truly became one of Galvanize's most successful campuses. So from there, we did Seattle, Austin, Phoenix, and ultimately New York.
Nice. Very nice. So, in tracking in that whole world, right? I mean, you guys as a hybrid, it was an interesting, I mean, like for me as an outside observer, watching as Galvanize came to Phoenix, it was such a unique thing, right? Because at the time, Phoenix didn't have a very good gravity point. It's the way that I described it for the entrepreneurial ecosystem.
It was all over.
Yeah. And Galvanize was one of the first things that was tangible, so it was like this whole digital world that we were all operating in. And then here came Galvanize as like a physical location. And you were doing all these things. It was just such a unique experience as a consumer to see Galvanize come in.
It was interesting we really wanted to be in Phoenix for quite a long time. And our landlord, who's awesome and also an investor, was just having a little trouble getting a loan for his building because we're not, we're a high growth startup, right? We weren't a credit worthy, big, late stage, profitable business. Right. And I never forget, I happened to be in Phoenix for the Phoenix Open, and our landlord set up a meeting with a bank that he really wanted to do a loan. And we sit down in the morning before we went into the Open, and the lead banker there, I think it was the president of the bank, he's like, "Why are you coming here?" And he's like, "You guys are, Seattle and Austin and San Francisco, and those are all really great hubs." And I'm just like, I feel like maybe you should be pitching me, given you are a bank that has a vested stake in Phoenix doing well. And I was like, look, if you want me to tell you, it's center of the country, low tax, it's a great place to live. Real estate's relatively inexpensive. I'm like, you can be in California really quickly. You can be in New York really quickly. I said, I think Phoenix is a great one. And I think it's just gonna be a great market. And it turned out to be a great place for Galvanize. But I found it interesting that I had to convince the locals that it was a great place.
Yeah, I can understand that, having lived in Phoenix tech ecosystem for about a decade. That makes me smile because I get it. Okay, so let's go back and examine, what really happened in more detail. So, you were in charge of capital raising. I think.
We all did capital raises. This is very common in the early days of a startup when you have basically 3 or 4 people. Is everybody does a little bit of everything, and your roles and responsibilities harden over time. I came from venture capital and I gravitated towards that. I loved telling the Galvanize story. And so we all worked together on it, but I would say, fundraising was definitely something I spent a lot of time on.
Yeah. Well, okay. I want to dig into that though. So, I think that there's a fair amount of, call it mystery, as first-time founders coming in and looking at this whole, it's kind of a process, right? And there are standards for getting, a company up to a certain point to be, call it worthy or qualified or whatever for venture funding. And it's a little bit of a mystery, even though there's lots of blogs written about it and everything else. Actually conducting that process is interesting. As you go through it, you trip all over yourself the first time that you try to pitch people. So I think that it's worthwhile digging in for a second on your comment that you were all fundraising. So, tell us more about that. Like when you say you're all fundraising, is this an organized effort? Are these one-off conversations?
Not in the early days. It wasn't organized in the early days. We had a couple of angels who backed us early. And so we had some capital to get going, not a lot, but we were able to at least get the ball rolling. And, fundraising is really about getting out there and having conversations. And as you get to hear yourself kind of pitch what you're working on and what your plans are, you benefit from that because you get better at it. You hear what resonates, what doesn't. And look, we were pretty embryonic at the time. And we had the benefit of being able to say to people, this is what we are going to be doing, right? Because we weren't ready to do it yet. We had to recruit an instructor. We had to find students. We had to fit out a campus. And, people just kind of watched us. And as we executed against it, and then they could come and see that it was real and meet a student and understand why they were there, then fundraising just got a lot easier. So we definitely had advantages. But look, in the early days, you're really asking people to back your reputation, or they know you and they believe that you're thoughtful. And it's less that they think it's going to be a massive home run. It's more that they think you're going to steward their asset, even if things don't go well. And they're early stage angels are okay with zeros. They just don't want to be treated badly in a zero. Right? They're like, if they feel like you worked really hard and you were straightforward with them and you did everything you could to protect their asset, then they're like, hey, that's life in the big city. That's not all my angel investments work, but I love working with great people, and I'll get it on the next one with them. And so we had some people early that backed us and believed in us when there was no evidence. And then as we started to have some evidence that we were onto something, we kind of propagated and just worked our way through. And look, I don't know, 2,000 fundraising meetings or calls throughout my time at Galvanize. And sometimes it took 10 to 15 to close one investor, and sometimes it took one. And it's just a weird process. And there were people who got all excited and told us they were going to write a big check and then just kind of went dark, and that's normal. It's just part of the deal.
Right. Okay. So tell us a little bit more. Give everyone an idea of, the ballpark of how much money you raised for Galvanize.
About $80 million over the 4.5 years.
That's no joke.
Yeah. And I would say the first 15 or 20 million of that was kind of angel family office. We didn't do it all at once, right? Obviously that was over time.
Right. Mm-hmm.
And then we closed our $18 million Series A with University Ventures. They're based in New York, and they only invest in kind of education technology businesses. They backed us in May of 2014, and great partners, awesome team that I still work with on things to this day. And then in summer of 2016, we closed on a $45 million financing led by ABS Capital Partners, so classic growth equity firm. Paul Mariani is the partner there, and I keep up with Paul. Very, very helpful to the business.
So I think it's interesting, even someone like yourself that came from venture capital and you had a lot of experience coming into this experience, a ton of credibility, you still don't close, deals. You don't get a check on your first meeting, right? Even maybe after five,
No.
you
I
know.
used to do sessions for community member companies. I don't know, every now and then, where I would talk about fundraising, and I had this slide, which I'm happy to send to you. And I literally had Adult Friend Finder on one side with a big X through it, and eHarmony on the other side. And I said, fundraising for a company in the startup space is a lot more like eHarmony. It is not one meeting, close the deal. You're going to have to, spend time building trust and kind of growing into the relationship before someone's going to trust you with their capital.
Mm-hmm. Yeah. So when someone's coming into a relationship, what advice would you provide to someone that's new, that's never raised money before, doesn't come to the table with really any street cred beyond their personal, professional experience? I mean, what can they do to level themselves up and come off as credible?
The number one thing that will help you is if you believe in the company you're building. If you have a vision for why this is going to work, and you have a thesis, and you have some kind of data points that kind of support that, that's going to help a ton. So kind of believing in what you're building and being able to convey that thoughtfully. I don't think early stage fundraising is really successful with the hand waving. I think the traits that are helpful are being forthright. Someone asks you a question, I don't know the answer to that. I have a hypothesis, and I'm going to go kind of think about that, and I'll come back to you. But a lot of times, I think early stage companies are amorphous, and nothing is clear. You have to have a ton of comfort with ambiguity, because everything is ambiguous, and you have to just kind of trust your gut and use common sense. And you're not going to have the answer all the time. And to try to do some long-winded answer with a lot of acronyms, just don't do that. Just say, that's a great question, I do not know. And here's what I think, but I'll come back to you. So yeah. I don't know is a perfectly acceptable answer.
Yeah. I think that answer is scary for so many people to put out there. Just admitting
investors don't expect you to be superhuman. They do not expect you to be superhuman. You don't have to know everything. You just have to have what does Jim Rome say? Have a take.
Mm-hmm. So let's put it back into the context of Galvanize again. I mean, you said that you were basically on a perpetual fundraising cycle for the 4 years that you were helping. So what does that look like? I mean, if you are, a young company and you're going to go out and start raising money, and you're looking towards this capital formation path that you're going to go down. I mean, does someone need to be in the mentality that they're always raising money? I mean, is that the CEO? Do they need to have someone else that's designated for that? I mean, how do you think about that from a business and a strategy and a time management perspective for, call it a 3-year horizon from the time that you pick up your first funding check?
Yeah, I mean, Elon Musk runs a, $500 billion market cap business in Tesla, and he's still raising money, right? He's doing debt deals. He doesn't have to spend any time on it anymore, right? He's got Goldman Sachs or some investment banker to do it for him. But what I would say is capital raising is a function of just about every business. Mm-hmm. So it's kind of part of the deal. I every now and then an entrepreneur like, it's so hard for me to run the business and raise money at the same time. I'm just like, yeah, that's entrepreneurship, right? It's totally acceptable to not do that and work at a big company and have a more sane pace of life and work 9 to 5. It's a perfectly reasonable decision. But if you decide you want to be in entrepreneurship and you're going to be in a leadership role, I think capital raising is going to be a part of what you do. So it's a little bit. I tell people it's a little bit like politics, right? Congress people, every 2 years they run. There's 2 ways to finance your campaign. You can do a little bit of fundraising every day for 2 years, or the last 3 months of your term, you can do really, really big fundraisers every night. There's kind of two ways to do it. The other way to say that is I worked, when I was in management consulting at LEK, I used to work for a guy who was an Apache helicopter pilot in Desert Storm. And we were kind of preparing for a client presentation with all this data. And he said, Chris, there's 2 ways to not get killed in a helicopter when you fly it. One, you're really good at your pre-flight checks and you're totally prepared and everything looks good. The other one is you're just really great at emergency flight operations and you can get out of anything. And I think, fundraising is a little bit like that.
That's awesome. So is it a fair assessment to say that maybe fundraising, from at least the founder's perspective, might just be considered like another vertical in the business? Like you have your marketing and you have 100%. Your product.
100%.
You should have, okay. And the owners have to be the founders. There's nobody else you can hire to really do that.
I mean, I shouldn't say it has to be the founders, but it's a little bit like when a really early stage company hires a chief strategy officer. I'm like, I think the CEO or the C-level person is the chief strategy officer because you're pretty early. It's a little bit like hiring an investment banker to do the capital raise for you. Yeah, fine. When you're, 50 million in revenue, maybe that's helpful to manage a process. But when you're an embryonic, no revenue company, you got to be able to sell this yourself, right? You got to be able to believe in it and convince other people. I mean, being able to convince other people to join what you are doing, either as a team member or an investor or a board member or as an advisor, like that is like core skill set of entrepreneurship. That's being resourceful. And that's probably the difference between a lot of companies that kind of break out of that early phase and start driving some real revenue, and those that don't.
Mm-hmm. Love that. Yeah, that's right on the money. So before we jumped in, we just mentioned briefly that capital in many regards, whether it comes from revenue or from fundraising, is really the lifeblood of surviving. So when it comes to survival, right, and having that survival mentality, what would you advise to founders as they're thinking about how to survive, right?
Cut your personal spending before you start a company. Give yourself as much personal runway as you can. Yeah. It's one of the things that's just not for the faint of heart. It's actually why you see a lot of people who have some inherited wealth start companies, because they have the flexibility to do so, or they have a spouse who has a stable kind of income that allows the other person to try the entrepreneurship path. And I'm not throwing any rocks at that. It's just give yourself as much runway as possible. Same story for the business. Give the business as much runway as possible.
Yeah, no, it's totally true. I mean, there's a huge advantage when you can self-fund.
You've got flexibility. Now, I could take that to the logical extreme, right? You shouldn't pay yourself zero for 20 years. At some point you need to be like, wait a second, I don't have any revenue. And that's bad too. So one of the things that, obviously fundraising and the big dollars that are raised, that's where all the news articles come from. So that's what people see in entrepreneurship, and that's what they anchor on. Oh my gosh, did you see that so-and-so raised $1 billion? Celebrating dilution is generally not good. So I like that you brought up financing the business through revenue, right? Everybody forgets there was one Walmart for 12 years, right? Rome was not built in a day. It's also very acceptable to build a business organically out of cash flow and grow more slowly. There aren't a ton of businesses where you have to fundraise fast to go faster. I suppose Uber and Lyft had to do that, right? Because they were competing with each other. But for a ton of solid entrepreneurial businesses, you don't need to raise capital. You can, find a customer and have one deal finance your first year and just be lean on employees and salaries. And then you get a second customer and what do you know? You pay yourself a little more or hire a second person. So I don't want to, try to say that not raising money is the wrong strategy. I think it's perfectly appropriate and better in many cases.
Mm-hmm. That's great. So I like talking about this because I'm a nerd in finance and venture finance. I think it's a lot of fun, but it's so foreign to most people. So can we shift gears for a second and talk about how to present the business model of a company, when you're really out trying to make this happen? I mean, Galvanize has very unique, kind of a proposition, right? I mean, you're doing in-person education, you have physical properties, there's some complexity there that makes call it the finance waters a little murkier than usual, like compared to a SaaS product that's, going to generate X, Y, Z, and you've got acquisition costs. I mean, you can run the math, right? But something like Galvanize, I mean, that's a little stickier. It's harder to project. So, I mean, would you end up relying a lot on trying to articulate and justify that a business model exists? Or was it the other side of the spectrum? And it's like, look, we're all smart people, we'll make it work, but we need the capital to make this thing work.
Yeah, every potential investor has things that are really important to them and things that are they're less interested in talking about. Some want to focus on sales and bringing in big contracts. Some want to focus on cash in the balance sheet. We had a couple of early investors, great banking family here in Denver, and he always would want to talk about the balance sheet with me. Where are we at, and what's this? And then I have others that want to talk about how many students are we gonna, how many people's lives are we gonna improve this year, and what are the impact metrics? Everybody kind of has their hop on. I think the key to fundraising successfully is to know your audience a little bit and figure out, what do they really want to talk about? So you kind of have to have it all, but I think it's where do you spend your time? And the unit economics for Galvanize weren't particularly complex. It was more just convincing folks that the the two sides of the business, if you will, really needed to go together. And that was something that some people just like, complicated. And I'm like, you're right. It's operationally intense to kind of have two businesses under one house. Here's why we think they fit together and how they feed off each other. But if ultimately you just view the operational intensity as a kind of too high a roadblock for you to get over, we understand. I think one of the things in fundraising is counseling people out quickly, because people in the deal world either get paid or enjoy looking at deals all day, every day. And there's only one you as the entrepreneur, and you just can't let that happen. You have to aggressively counsel folks out of your process that are wasting time. And you can do it graciously and just say, hey, look, this doesn't seem like a great fit for you. You've heard the pitch. Now you get to watch us execute. I'll keep you posted. I'll put you on our newsletter, and just ping me down the road if we move into an area that you're more comfortable with. All good. And then you have the benefit of putting up the velvet rope where they can't get into the club, and then they want to invest in some cases. But counsel people out aggressively, and don't waste your time. If someone's a big time biotech investor and you're building a SaaS company, then don't pitch them, right? You just don't waste your time pitching, folks that aren't going to get to yes or don't have the authority, or just, be gracious, but aggressively counsel potential investors out of your process.
Yeah, absolutely. I love that advice. I think that when you're new in the game, at least my observation has been, you get so excited when anyone that has capital is even willing to have a conversation with you. And then it's almost like someone that's never been in a relationship before, and they get a girlfriend, and then they just love them too much. They're not, you might not be a good fit, but you know what? You said you liked me. And so I'm not going anywhere.
Look, it's when you're doing a pitch, you're teaching that individual your business and your sector. So it's valuable to them just to learn. So whether they're interested in the deal or not, they're just like, man, I didn't know that. That's really interesting. And there's like a thing when you're a potential investor is just hanging around the hoop. I don't want to say no. If something really good happens, Sequoia is going to come in and lead around, and then I'll get to tag along. So you just don't want to let that happen. You really want to find people that are truly motivated and feel like this stage of the company is right for them, and they really believe in what you're building, and they have a kind of relationship with you, and they want to back you.
That's fantastic. So getting in, I want to be specific on the financial model too. So did you spend, I guess you answered it in the sense that everyone's going to have something different that they want from you, right? But you have to be ready, so to speak, right? So if that person that's really wants to understand how the dynamics of the business model work, and they want to see a financial model, I mean, you got to have it. Even if 70% of the other investors don't care, you need to have it for them, right? So you're really preparing yourself, not just with a financial model, but you're catering your decision across several different types of investors who have different priorities. Did I hear that right in terms of being prepared and being able to cater to the investors that ultimately care?
Yeah, and look, in the early days, like let's say you're less than 200 grand of revenue, your financial model is probably not a nuclear wristwatch, right? It's probably like 10 lines in a spreadsheet. This is what we sell. This is what we think we're going to sell it for each time. And, we think, in the first year we'll sell 3 of those. So here's our revenue, and here are the costs for us to deliver that or build it. And, I think it's pretty high level stuff. And then, your employee headcount and what that costs, and office space and travel. That's not too hard to create a simple look. It gets more complicated as the business grows. But of course, then you can start layering in some finance resources to help you build a real model. The Galvanize model from 2012 is pretty rudimentary. I still have it. And the Galvanize model from 2016 is incredibly powerful. It's truly like a growth equity financing model. And so that evolves over time.
That's really good. So let's go back and talk a little bit more about the initial Galvanize. So you gave us some sneak peeks into kind of how that worked and what that initial product was like. You had some chicken and egg scenarios there, sounds like, right? In terms of like, you're getting instructors and you're trying to get students. You didn't have a space yet, but you had to teach somewhere.
Nope, didn't have a space. Had to figure that out. We're doing it all in parallel.
Yeah. So specifically within that, real quick, how were you financing the business at that point before you had all that figured out?
Yeah. So we had a couple of angels who backed us really early. People who were just captivated by the idea with no execution yet, and backed us, not with big dollars, but enough where we could get the ball rolling. We had a very lean team. We didn't spend a ton. And at the same time as we were working on securing and kind of fitting out the first campus, I was flying to DC to recruit our instructor. I basically spent 3 months traveling the country trying to meet anyone and everyone who's doing alternative types of software developer training. And we found a guy in DC, and it just happens to turn out that he and his wife had talked about moving to Denver, and we were able to recruit him. And then we said, okay, great. So what do we do now? And we're like, okay. So we got an instructor. We're working on the space. Now we need students, and let's put a website up and ask for applicants, tell them what we're doing. And it's a little bit like that movie, The Martian, with Matt Damon. He's like, do the math. You figure out what the first problem is, and you solve that one. And if you solve that one, then you get to solve the next one. And you just you solve enough problems, you get to go home. Or you solve enough problems, you get to raise some money.
Right. Yeah, that's awesome. So in that initial stage, how long did that take, from the time that you guys really had that inception?
Yeah, we really kind of started. We were working on securing the campus and fitting it out second quarter of 12. That's when I was out trying to recruit the instructor and figure out what the product on the education side looked like, how long, how much it was going to cost. We opened the first space in October, and students showed up January of 2013. So what's that, 9 months-ish? Mm-hmm. Yeah, that seems about right.
Yeah, that's pretty good. Were you guys all full-time on it during that period of time? Or
we were actually, yeah. That was one of the things, I think burning the boats and committing to it and saying, we're going to work on this. Like we're going to try to figure this out. And obviously, if we had not figured it out, that would have ended at some point, which is okay. That not every idea is going to work out, and there's no shame in that. Trying to start something greenfield is really hard. So I don't throw rocks at people if they try to start something and it doesn't work out. It's like, look, give it another try.
Yeah. Okay, so you also mentioned that you've been an investor in a lot of other businesses. You mentioned a couple of them. Do you want to mention any of those names that you've been able to participate in?
Yeah, a couple fun ones. I don't like to talk about the 200 that didn't work out, but every now and then you do like a Ping Identity, which was a really fun one. We sold that to Vista Equity Partners. We did well. Vista Equity has done even better with it now that it's a publicly traded company. Same CEO, Andre Durand, is just amazing. Another good one, Datalogics, just sold to Oracle for $1.2 billion. So look, entrepreneurship's fun. You get to work with people that are changing things, build something cool. And like I said, they're not supposed to work. And so when and if you do have a big winner, it's awesome.
Yeah, that's great. If you look sideways at some of those other successful companies, did they do anything differently than the ones that didn't make it? Or was it more just kind of luck of the draw?
Super talented people is very helpful, right? There are operators that are just incredibly smart and work incredibly hard. And so I can't say it's just luck. Isn't it funny that, the luckiest people are those that work the hardest? So I think, but by the same token, there are people that work really hard and it doesn't work out. So I think there's a mix there of you kind of hit things at the right time, and you're also really smart and busting your tail. We got lucky a ton at Galvanize. People backed us when they shouldn't have, or we were able to get a financing done with 3 weeks of cash left, or a big customer bet on us and said, no, we're going to do this multi-year, multi-million-dollar transaction with you. And so I think a little bit of good fortune and a lot of hard work and smarts, and it's an amalgam.
Mm-hmm. Oh, that's awesome. So amidst all of this, you've been out of Galvanize for a while. Are you at all
peacefully retired from Galvanize?
Oh, peacefully retired.
Because it was trauma for 5 years, and my boys were 0 and 1 when we started Galvanize, which made it even nuttier. I was insanely caffeinated for those 4.5 years.
So what, you're saying your kids were 0 and 1?
Correct.
Yeah. Oh yeah, that is
just
a handful.
Just straight up poorly timed.
Yeah. Well, I think that's an interesting topic for just a second. Talking about family and going through a process where you're constantly fundraising, and you're building, a little mini empire inside its own context. So how did you balance family amidst all that?
Oh boy. I think what we told ourselves is that we did a really good job balancing family and work. We would, kind of do mornings with family if we weren't traveling or had meetings, grind during the day, leave at 5 so we'd get home and do evening family time. Try to get everybody to bed, and then crank until 3 a.m. if you have to, and then wake up and repeat. So that's balance, I guess. The downside, and what I didn't realize at the time is you're at like a family event, like say with your wife's family, and you're off in the corner and you're sipping your wine and you're just kind of not really there because you're trying to grok some $5 million problem you're dealing with, and your in-laws think you're an asshole. When you're not, you're just really focused on trying to keep your business from dying. And I think you don't realize that you're not balancing it well until you're out of that.
I'm sure your wife helped you clue in a little bit.
Yeah, when I finally left Galvanize after we closed the big Series B round and the company was in good shape, I did the "I'm really sorry, honey. Let's go to Hawaii for a 10-day trip," and that was how I started, kind of thanking her.
Yeah, no, that's great. Oh, I'm glad that you kept her in focus. Well, let's we've got one Q&A question, and then we want to go to some of your final thoughts. So someone here asked, many big tech companies have recently expanded to the Denver Boulder area. How do you see this impacting the entrepreneurial scene in Denver?
Yeah, great question. Totally relevant given all the like HQ2s that we're getting for some great businesses. Like we functionally have Slack's HQ2. Stuart Butterfield came out about a year ago, and I was able to moderate a discussion with him for the press, just talking about why, Denver was their first cross-functional office outside of SF. And, it's very similar to what I said about Phoenix, right? Center of the country, great kind of climate, educated workforce, relatively low cost of living vis-a-vis the coasts, business-friendly tax policy. And, I just think, when I moved to Denver in 99, 20 years ago, I was a little early on the trade. We were still kind of flyover country. And now, geez, Denver is like a tier 1 market. Everybody wants to come to Denver. Anytime a house in this part of town comes up for sale, it's someone from California or New York who's buying it. So I think it's great to have that activity here, and entrepreneurs here that are here, native here, will benefit from that. And entrepreneurs that come here will benefit from that because those assets that we have aren't going anywhere. I think we'll continue to have bigger and more prominent tech companies, right? SendGrid grew up as a public company and was sold to Twilio. Ping Identity is a big public company based here. Zayo got to be a $13 billion public company. It was just taken private. There's some really good ones. And I think that will continue. I do think the collegial vibe of, the Midwestern ethos that we have in Denver will change over time, right? San Francisco and New York, as far as I found them, are a little less welcoming to kind of people trying to break into the entrepreneurial tech scene. And so I'll work as hard as I can to make sure we kind of keep the Midwestern, let's support each other, let's make the pie bigger, as opposed to we're all slashing each other's throats.
Right. Well, I agree with that. That's one of the reasons I chose to come to the Denver Boulder area as well. It's good. It's right there, and I see good things for it too. Well, why don't we turn a few minutes over to you? If you looking here, speaking to our audience of young entrepreneurs who are in the trenches or thinking about jumping in, what would you have wanted to know back in the day when you were a novice and when you were early in this whole process?
Yeah, look, tech has come a long way, and it really has democratized access. And something we really believed in at Galvanize is let's make this a way for anybody who wants exposure to the tech and entrepreneurial world to give it a go. Right now, you can get a desk at a Galvanize, you can set up a Gmail account, you can set up, Salesforce really quickly and easily. Gosh, back in the early 2000s, you probably needed to spend a couple $1,000,000 to spin all that stuff up. And so I think the barriers to entry are much lower, and to starting a company, and that's good. But the barriers to building a business are just as high as they always have been. And I think a strong vision for what you are trying to accomplish and why your customers will benefit from that, and kind of a sense of what the economics could look like. You don't need to know exactly, the market's this big, or we're going to make 48% gross margin or 72% gross margin. But I think some kind of sense of vision of kind of why you're doing this and who benefits, just a great place to start. It's just going to help you recruit others to join you, whether it's team members or advisors or potential board members or investors, all the above.
That's really good. Yeah, I tend to agree that on everything that you're saying there. We have one other chat that came in: recommendations for hardware, embedded systems funding routes in Denver and Boulder. That's a pretty specific question.
Pretty specific. There are some successful hardware execs, particularly in and around Boulder. And so this is where, Google and LinkedIn, you kind of have to ham and egg your way to it. Now, the benefit of Denver Boulder being a relatively tight knit community is find the right advisors. So like a law firm that's been in and around, and someone who, not like your mom's real estate lawyer, but like a kind of tech and entrepreneurial firm. It doesn't need to be a big firm, but it could even be a one-person shop. But they tend to know who the investors are for certain sectors. The same with, accountants that focus on entrepreneurs. There's one accountant in Boulder, Chester Kurtz, who does all the tax returns for like every entrepreneur who runs a company. There's people like that. And then as you get bigger, you get to go to Plant Moran or KPMG, you get to see Erica Whitmore at KPMG. So I think leverage advisors that want to help you. All of those advisory firms, they know that when you're young and you have two people and no money, you're not going to be able to pay them. They get it. And they just want to help the ecosystem. They want to help people kind of find access to support. So I think the question about, hardware or embedded systems, Tim Enwall in Boulder has done a ton of those, and he knows that really well. Google, LinkedIn, it's so much easier now. Just can you imagine entrepreneurs in like the late 80s, early 90s, like how do you find capital? It was just totally unfair because it was really, really hard, right? And so much easier for us now. It doesn't make, now I'm not saying it's easy, it is easier.
Indeed. Yeah, I mean, we've already discovered that too. I mean, just working, in Sweater's vision of opening up venture capital as an asset class to everyday people. I mean, it's, you have to surround yourself with people that understand the what and the how of going about it, right? I mean, we can talk to anybody, and most people say, hey, that sounds really awesome. But the people that can actually move the needle and can advance the company are those that are in the space that understand very specific things. And we just made some really big breakthroughs just in the last few weeks that have allowed us to turn a completely different corner. And it was because of the people that we got in touch with, not because we were so smart or whatever. They helped us connect the dots in a way that we couldn't have done. And that's exactly it. So I love that advice, getting in with the right kind of people that understand and that want to help. Because there are some people, that don't want to help, and I think it's pretty fast.
And that's okay. You don't want to push a rock up the hill, right? Just
Right,
find the people that do want to help and are kind of interested. Yeah, I'd be happy to give you an hour a month on the phone or over coffee. And because a lot of entrepreneurs who've been through it know how hard it is, and they're happy to like be a sounding board on a fairly light basis. And that's a great way to just get plugged in. Oh, my buddy does something like that. Let me introduce you.
Yeah, that's awesome. Well, thank you so much for joining us, Chris. This has been awesome having you in here. We appreciate you making time and sharing your experience. It's venture is one of those things, I think, that you might agree that you can't learn it from a book. You just have to get out there and do it and live it and have some experience and watch yourself fail and watch other people fail and watch yourself succeed and watch other people succeed. And, sometimes it's just out of your hands, and hard work will take you in the right direction.
Yeah, well said, man. Well said. Thanks for having me on. I appreciate it.
Yeah, you're welcome. All right. Thanks, everybody.